Hello there, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you. Today's topic is trading styles. So I've got several different trading styles listed. By the way, there is not a right or wrong necessarily. There are preferences. Now, there may be times when one style is more suitable to a particular market than another. Certainly, some of these styles are going to be a bit determined by your level of education. So, that is going to be a factor as well. And also, just your level of comfort. So, there'll be some people that might like to be a certain style, but just aren't really comfortable trading that or don't have the results that they desire. So, they just simply say, you know what, I'm just not very good at that. And I think sometimes a realization that can be truth is a good thing. Now, sometimes we're not good at something because we need more practice, we need more training, we need more education, coaching, teaching, etc. Sometimes we're just not good at something because we're not very good at it. So we'll go through these styles, and then you can kind of see, well, which one do I feel like fits me, and does that make sense, and can I do something more? Is there an area where I ought to be striving to get better, and if so, what does that look like? So I've actually got a little PowerPoint today, which is pretty rare for me, but this is actually some material I've shared before. So I'm going to bring this up and let you guys kind of see this here in the background. So let's bring that up. All right. And so what are the various trading styles? So as we go through this process, what does it look like? How should I be thinking through these? And that's what we're going to focus on here today. All right. So the first trading style that we're going to discuss is called buy and hold. Now, buy and hold is exactly what it sounds like. Most amateur investors are simply buy and holders. And what they basically do is they buy a stock or a number of stocks, and they just simply buy and hold them. Now, their reasons for buying those particular stocks may vary widely. It may be like, oh, I bought a phone from this company, so let me go, buy some of their stock too. Oh, I like their food. Let me go, buy some of their stock. I read some stuff about, this industry, so I want to go, buy some stock in that industry because I think it's going to go up. Or I've seen these stores expanding in different areas, so I'm going to go buy some of their stock. Whatever reason, somebody might have told them, right? Hey, go buy this stock. So they're like, okay, you sure? Yeah, go buy this stock. So then they go do that. But they're buying holders, all right? So they buy and then they hold, and then they hold, and then they hold. So what is the drawback to this? Well, the drawback to it is you only make money when you sell. So you can buy something and then hold it and then end up, dying. And then you still own it and you're just passing it on to somebody else, but nobody's made money on it. You didn't make money on it the whole time. Now that stock, let's just say you bought it at like $5 and now it's worth $100. You could have made $95 a share, but you only make money when you sell. And for most people that are true buy and holders, the reason that this kind of fails them is that they have no real plan of where to sell. So they may have, some target in mind. I've heard stories of people that say, I bought it at this price and I was going to sell it at, let's just say, $100, and it got up to like 99 something, and they were ready to sell, and then it fell, and then it just fell and fell and fell and fell and fell. And I've heard some people even say they took expenses. So they might have been up a lot of money, but because it didn't reach a certain price and it came maybe within pennies or a few dollars of hitting their price, and that was their only, rationale or reason for selling, is if it hit that price, then they ended up holding that thing. And now, it's just unrealized gain. So, can you make money buying and holding? Yeah, absolutely. You can make money buying and holding, particularly if you were to enter a trade to buy a stock near the low. Now, for most buy and holders, the buy point isn't a really, really important issue for them. They're often not going to be aware of what a good buy point is. Again, they're just simply buying for some other reason, but not necessarily because they think it's at a good buy point. In their mind, they're just going to buy this thing so in theory, they could sell it later at some much, much higher price. But because they don't really have a plan in mind, it's just kind of just out there. So they're not actively engaged at all. This is a very passive mindset for sure. You don't need to look at the market every day. You obviously don't have a plan to do anything with your stock from one day to the next. So outside of just, checking your report that you get from your broker to see, am I up or not? Remember, all that's unrealized gain anyway. There's no real point in checking this every day because it's a very, very passive mindset and trading style. It's a buy and hold. So again, if you get in at a lower point and you sell at a higher point, you certainly can make money through the buy and hold methodology. All right. So next up, which again, we're going to go from most passive to most active, is a semi buy and holder. So a semi buy and holder is someone who has a plan to buy. They're not going to watch it every day, but they do have a plan to sell in, say, a couple of months. So they are semi buy and holders. So they're not very active. They're not out there again watching this stock every day. But they do have a sense of, okay, I bought it at $5. When it doubles in value, I'm going to sell. So there is a sense that yes, I do have some target in mind. It's a realistic target. It's not just like I'm just gonna buy this thing and then hold it till some undetermined amount of time when I think it might be right to sell. These people are going to sell, and they have a little bit of a predetermined plan, at least, for when they're going to try and sell. But again, a little bit more active again because they do have a plan, whereas the true buy and holder really has no plan to sell. It's just kind of out there someday. Maybe I'll sell. And the fear of the true buy and holder is that they'll sell and then the stock will keep going up. So the true buy and holder would almost rather take an expense and lose money than to sell too early and have the stock keep going up. That's actually their biggest fear, is that if they sell, they could have made more money. So most of them end up losing money because they hold until the market and that particular stock starts to fail. Whereas a semi buy and holder says, you know what, I've got a plan in mind. When the stock reaches that point, I'm going to sell and I'm going to be fine with my profits. Is there opportunity for you to make money here? Yeah, absolutely. Now, you have to be reasonable in your sell point. Again, you could be in this trade for weeks or months or perhaps even years, but you do have a definitive plan on when you're going to sell and what that price might look like. Next up is what we call swing trading. Now, swing trading is a little bit like, the actual things that you did as a kid and maybe even as an adult. You get out there and you got the swing and it goes forward and then it goes backwards and it's forward and it's backwards. And this is what we primarily teach here at Tradeway. We are trying to, as they say, trade the trends. And so what we're looking for is a movement between what we call support and resistance. So basically it does require a more active trading lifestyle. Now, most of these trades are going to last from a few days to a few weeks. Could you be in some of them longer? You certainly could, but for the most part, we're looking at a few days to a few weeks for the stock to complete its pattern. And as it moves from support to resistance, so we've got a good idea. This does require charting. So you're going to have to be able to look at a chart, understand a chart. So it will require a little bit more education than the previous two styles, which are basically just, buying at some point with a sell point in mind. This has a very, or should have, a very clearly defined buy point and sell point in mind, and you ought to be able to see this from a chart. Now, again, I mentioned it is more active. You don't have to stare at your computer all day. The stock is going to do whatever it's going to do, but it gives you a chance to have an idea of here's what it ought to do and here's the time that I think it ought to take. But you have very clear ideas of when you would buy, when you would sell, and if the trade doesn't work, when you would stop out and try to take a small expense. All right, so this next style, short-term trading, is much more active. This is going to require that you spend probably a little bit more time in front of your computer. Short-term trading is basically the idea that your trades are going to be over, in a couple of days, maybe. So you might be in that trade for, 2 days, 3 days, maybe 5 days, maybe, a week and a half, something like that. But very, very clearly defined, again, patterns, ideas of where your stock is going. It does, since it has the potential for greater returns on investment, it is going to require more activity on your part. Again, it will require you to understand what a chart is and how it works and understanding movement over time. For most people, this is going to be a very defined movement from one place to another. And there are a number of Tradeway students that would term themselves as short-term traders, particularly if they are trading options. I would say, especially with debit spreads, that somebody in that realm would classify themselves as a short-term trader, really trying to take advantage of the return on investment here. And some of those can be quite high. But yeah, you have a very, very clearly defined, or should have a very clearly defined entry and exit for this type of trading style, and it is quite active. And then the last one, which would be the most active, is called a day trader. Now, a day trade is a trade in which you enter and exit that trade on the same trading day. So if I were to get in at the end of today, so we're Central Time here, market closes at 3 o'clock Central. If I were to get in at like 2:45, and then the market opens again tomorrow at 8:30. At 8:35, so if I entered at 2:45 and I exited at 8:35 the next morning, technically I was only in that trade for 15 minutes today, 5 minutes tomorrow, 20 minutes total of trading time. That's not a day trade, even though I was only in it for 20 minutes, because it's not the same calendar day. However, if I were to get in at any point today and I were to close that trade at any point today, then that is a day trade. So you could be in that trade for several hours today. You could be in that trade for just a few minutes today. But if you open and close the position in the same calendar day, that is a day trader. Now, obviously, day trading is the most active. Yes, they are going to be using charts. They're going to be using short-term charts, normally minute charts. They're going to be looking at movement over a short period of time. They're going to be willing to take less money from a specific movement, so they may not be looking for a $2 move. They may be looking for a 50-cent move, but they're trying to trade enough shares to make that worthwhile. And again, if you get a 50-cent move and you have, say, 1,000 shares and you make $500 here in a few minutes, you can see how for some people, though that would be a quite stressful way to make a living, it could be rather fruitful. Now, most of our students are like, I don't need that kind of stress in my life, so they're not really interested in day trading per se. And we have very few people that are actively out there day trading, as far as I know. But it is certainly the most active of all the styles that we've looked at today. It does require the greatest time commitment, and again, in some ways, it also is the most risky, if you want to apply that word. I think that that would be the case here, that day trading would certainly qualify. And then as you work your way down, in some ways you might could make the case that, all the way to buy and hold would be the least risky, depending on what you're trying to do, and your personal involvement in that movement back and forth. So those are the various trading styles, and you might find yourself thinking, hey, I'm going to do this kind of style. And then you may find over time that as you gain more education, as you gain more experience, that you find yourself, maybe moving towards a more active lifestyle. But you don't need to see these as necessarily steps or goals. Like, the goal isn't to necessarily become a day trader. It's like, oh, I've worked my way from a buy and holder to a semi buy and holder to a swing trader to a short term trader to a day trader. Even though I would say that there is a natural progression up until at least, swing trading or short-term trading. Day trading is going to be completely up to you, because you're looking for something quite different than you would be looking for with some of those other styles of trading. So that is our tip for today. Try to find yourself in one of these styles. You're going to gravitate towards one or the other, but that doesn't mean you need to get stuck in one style unless that style works for you. And if it works for you, then great. Do well at what you do well. All right. And if you feel like, what, I would like to maybe consider something else, but I do need some additional education, some additional training, some additional coaching, let us know how we can help you here at Tradeway. All right. Thanks for being with us today, guys. That is our Tip Tuesday, and we will see you next time.